Imagine there is a real machine in this world, one that makes no sound, gives off no light, and sends no warning at all. But once it is switched on, it can quietly turn a few $100s into millions, then turn those millions into power, legacy, and an entire system that keeps operating long after you are gone. It sounds fictional, but the most unsettling part is this. That machine is real, and every wealthy person you see today turned it on a long time ago. This story does not begin with $1 million, and it does not begin in the boardrooms of the elite. It begins with a small amount of money, a very ordinary decision, and a mechanism most people only understand when it is already too late. Stay with this story until the end, because the thing keeping you poor may not be that you earn too little. It may be that you never turned this machine on. You have $4,200 sitting quietly in a savings account, and most days, you do not think about it at all. To you, it is just money kept aside for safety, a thin layer of protection between your life and the unexpected. But somewhere in the background, the bank is using that same money, the money you think is standing still, to help fund massive loans, while you receive only a tiny amount of interest in return, so small it barely feels worth noticing. Every 2 weeks, your paycheck hits your account, then quickly disappears into bills, food, and everyday expenses. You save a little, but you have never truly understood that money does not only need to be stored, it can be programmed to grow, and that is where everything begins. Then one day, you hear the term compound interest again. Before, it was just a vague phrase from a classroom, the kind of thing people nod along to without really understanding, then forget almost immediately. But this time is different. You decide to open a high-yield savings account paying 4.5% a year. It is not some dramatic life-changing move. No one applauds, no one calls it a turning point. You simply set up an automatic transfer of $200 a month and let the money move without asking for your willpower every single time. It is so simple, it almost feels harmless. But in that quiet, ordinary moment, an invisible machine is switched on, and you still have no idea what you have just begun. At the end of the year, you check the account and see the amount of interest you earned, $89. Just $89, not $890, and definitely not $8,900. Just a number so small it almost feels insulting compared to the quiet expectations you had been carrying in your head. You look at it and feel, and the answer is yes if all you can see is the present. But it is completely wrong if you understand that this was never really about $89. That tiny amount of interest is not the reward. It is the proof. Proof that money has started making money. Proof that the mechanism is now alive. And from this point on, the thing that is growing is not just your account balance, it is the leverage of your future. That is when you realize a slightly uncomfortable truth. Saving money does not make you an investor, it only makes you a depositor inside the system. And for the first time, the gap between those two identities becomes painfully clear. One person leaves money sitting still and hopes it stays safe. The other learns how to put money to work. So you open your first investment account. You choose an index fund. You put in $500. Your heart beats a little faster than it should for a decision that looks so small from the outside. But that moment is the real turning point. You are no longer just holding money. You are beginning to direct it. Then you turn on dividend reinvestment. To anyone else, it looks like a forgettable little setting, but you know you have just added another layer of force to the machine. Every small payout is no longer taken out to be spent. It is sent straight back in to buy more of the very asset that is already producing returns. Money begins making money, and then that new money goes right back to work again. In the first month, the gains are almost invisible, small enough to miss if you are not paying attention. But by the end of the year, you have invested $6,300 and started to see your first real signs of growth. Not an explosion, not some overnight transformation, just quiet acceleration in the dark. Then the market teaches you its first lesson in the coldest way possible. In a single week, your portfolio drops 6%. $300 disappears almost overnight. It is not enough to ruin you, but it is enough to expose your real instinct, fear. Your hand moves toward the sell button almost automatically. In that moment, every theory you have learned about long-term investing suddenly feels fragile in the face of a very real loss. But then you stop. You put your phone face down, take a breath, and do not sell. It is a small decision, one no one else sees, but it is the first time you truly defeat yourself. Because at this level, the hardest thing to overcome is not the market, it is your own panic. After that drop, you open a compound interest calculator and type in what looks like an innocent little formula. $500 a month, for 40 years, at a 10% annual return. The number that appears on the screen stops you cold. $3 million. Not from one big break, not from luck, just from time, consistency, and the discipline not to sabotage the plan halfway through. From that moment on, the way you see money changes completely. It is no longer just something to spend, save, or show off. It becomes a silent worker. Every dollar you invest is like hiring another employee to build your future, day and night, without complaints, without breaks, and with more power every year you leave it alone. From that point on, you are no longer someone casually experimenting with the market. You begin to live like a real investor. Your portfolio has grown to $47,000, and every Sunday night, you open your net worth tracker like you are checking the pulse of your future. You take advantage of every structure that works in your favor. Tax advantage retirement accounts, the full employer match, and low-cost funds with fees so small they barely create friction. For the first time, you understand that wealth is not only built by how much you earn, it is also built by how little you allow to leak away over time. A 1% fee sounds harmless, until you realize it can quietly consume hundreds of thousands of dollars across decades. So you rebuild the system. Simpler, cheaper, cleaner, more efficient. And from that moment on, your money is not just growing, it is growing with less resistance than ever before. When friends ask you how they should invest, you no longer give exciting answers. No hot coin, no secret stock, no once-in-a-lifetime opportunity. You give them the boring answer. Automate, diversify, and leave it alone. It sounds so simple that most people assume they already understand it. But you know the price of ignoring simple rules. Because the biggest lesson you learned was never about finding the perfect asset. It was about understanding time. Compounding does not grow in a straight line. It accelerates. The first $100,000 takes years. The next one comes faster, then faster still. And at some point, your portfolio earns more in a single quarter than your old salary did in an entire year. No one applauds that moment. But that is when you understand the truth. Real wealth is built in silence. And the reward belongs to the people patient enough not to destroy what they have already built. Then your net worth crosses $400,000. A number that once sounded like it belonged to someone else's life is now sitting inside your own spreadsheet. But strangely, you do not celebrate. You do not post about it. You do not tell anyone. You just quietly open the file and run the numbers again. Almost as if you need to make sure your eyes are not lying to you. Because at this stage, your mindset has changed. The goal is no longer the feeling of winning. The goal is to avoid interfering with something that is already working beautifully. Then the market tests you again. A rising rate cycle drags your portfolio down 19%. On paper, you lose $76,000, a number big enough to freeze most people. But this time, you do not panic. You add another $600 that very month. No dramatic speech, no bragging about buying the dip. You just do what the old version of you was never calm enough to do. Keep feeding the machine while everyone else is running away. From there, you move into a different layer entirely. You are no longer just buying index funds and waiting. You begin optimizing the full architecture of your wealth. You add municipal bonds for tax efficiency. You add REITs for real asset exposure and income. You stop thinking in years and start thinking in decades. The calendar on the wall still looks the same, but in your mind, time now moves differently. Your emergency fund covers 12 months. Your insurance is airtight. Your estate documents are signed. Your beneficiaries are listed correctly. From the outside, all of it looks painfully boring. But you understand that this is what durable wealth actually looks like. Not flashy, not loud. Just a system that is tight, stable, and increasingly difficult to break. People around you start calling you lucky. You do not argue. Because only you know that this kind of luck was built out of thousands of correct decisions made quietly, over and over again, with no audience and no applause. Then, one day, your net worth reaches $1.2 million. No bell rings, but the financial system begins to treat you differently. Doors that did not even seem to exist in your old world start opening quietly. Private equity, private credit, co-investments, opportunities the average person will never even see. For the first time, you understand something most mainstream finance content never says out loud. Once you cross a certain threshold of capital, the tools themselves change. You are no longer earning only through stock appreciation. Now your money is working through multiple channels at once. Capital gains, dividends, private credit income, depreciation benefits, tax structures. You are not standing on the same board as your former self anymore. The board changed. And so did the rules. But the next level is colder than that. It no longer asks what you know. It asks what rooms you can enter. Once your wealth reaches $6.4 million, family offices begin to appear, along with quiet invitations into pre-IPO deals, structured notes, and hedge fund allocations that are closed to the rest of the market. And the most shocking part is not the return potential. It is the architecture behind wealth itself. Your effective tax rate falls, not because of anything illegal, but because of carefully built legal structures, opportunity zones, charitable remainder trusts, stepped-up basis, Delaware holding companies. At that point, you realize the wealthy do not just have more money. They operate inside an entirely different financial system. Money is no longer just a way to live better. It becomes a way to buy access, leverage, and the power to design the future for people who have not even been born yet. Then you reach the point where money stops being just an asset and starts becoming position. Once the scale of your wealth moves into the tens of millions, you are no longer simply an investor. You sit in closed-door meetings, take part in deals your name may never be publicly attached to, yet the fingerprints of your capital are everywhere. You sit on private company boards, co-sponsor venture funds, and use your liquidity to treat 30% market crashes as buying opportunities while most other people are forced to sell at the bottom. And that is when the most unsettling realization hits you. The system is not broken. It is working exactly as it was designed to work. The people with capital, time, and protection become more capable of buying more assets precisely when everyone weaker is forced to let go. At this level, compounding is no longer a personal finance lesson. It is a machine that widens economic distance over time. When your wealth grows past what an ordinary investor could ever imagine touching, you are no longer just buying assets, you are allocating capital like someone operating a system. Every decision now asks a different question. Where should this money flow in order to create the highest efficiency with the least friction? Stocks, dividends, private credit, tax shields, depreciation benefits, everything begins running at once, like multiple engines inside the same machine. You realize you are no longer playing the same game at a larger scale. You are playing an entirely different game. And what makes you stronger now is not just the amount of money you already have, but your ability to use capital as a key that unlocks access to even more capital. Then money stops asking what you want. It starts asking who you know. At this level, family offices begin to enter the picture, along with quiet invitations, pre-IPO deals, hedge fund allocations, and structured products that once sounded like they belonged to a different world behind a glass wall. You sit in conversations where every sentence is short, cold, and expensive. No one is selling dreams anymore. They are selling access. And you come to understand a truth very few people ever say plainly. The wealthy do not simply have more money than everyone else. They are allowed to step into an entirely different financial system, where the returns, the risks, and even the rules of the game have all been rewritten. This is the point where wealth begins to change its nature. It is no longer about living comfortably or retiring early. It becomes architecture for generations. You open accounts for your children the moment they are born. You build the legal framework, the education funds, the holding structures, and you calculate returns not for the next 5 years, but for the next 18, the next 30, even the next 70. For the first time, you feel something almost unsettling. At sufficient scale, compounding is no longer just a personal finance tool. It becomes a force that pulls through time, turning money into influence, influence into position, and position into inherited economic advantage. As your wealth keeps expanding, power is no longer something you have to chase. It starts moving toward you on its own. You find yourself sitting on boards, co-sponsoring venture funds, and sharing rooms with people who can influence capital, policy, companies, and the future direction of entire industries. The chilling part is that you did not go looking for power, yet capital at this level creates proximity to it, whether you want it or not. And you begin to understand something even harder to swallow. When the market falls 30%, people with liquidity and protection see opportunity, while people without a cushion are forced to sell just to survive. Their losses move through the system, and some of that value eventually flows upward to the people strong enough to stay still. The system is not malfunctioning. It is doing exactly what it was built to do. At this stage, you are barely an individual in the old sense anymore. You are a trust, a holding company, a foundation, a partnership. The name attached to the assets is not always even your own. Everything is placed inside structures designed to survive, to keep growing, and to remain protected without needing your direct presence. A foundation retains 2% every year and feeds it back into principal. The capital keeps compounding. Your descendants are born several steps higher on the ladder than most people will ever reach in a lifetime. And that is when the full truth becomes impossible to ignore. At sufficient scale, compound interest does not just create money. It creates legacy, institutions, privacy, distance, and choice. But at the same time, it also quietly takes something from you piece by piece, the simplicity, the immediacy, and the feeling that you are still just one human being moving through the system. And after all of that, the story does not end at the top. It circles back to the beginning to a 2-3-year-old walking into a glass tower on his first morning, opening his very first investment account, setting up a $200 automatic transfer, and thinking he is simply trying to become more responsible with money. What he does not understand is that the $200 was never the real protagonist of the story. The real protagonist was always the mechanism. The machine was always the point. The thing that would keep running silently for decades, growing in the dark, changing form from saving to investing, from investing to capital allocation, from capital allocation to structural power, and from structural power to multi-generational legacy. From the smallest number to the highest level, this story was never truly about money. It was about who understands the mechanism early enough to switch it on, and disciplined enough never to switch it off. So in the end, the most dangerous part of compound interest is not that it can make you rich. It is that, once it has enough time, it stops behaving like a simple financial concept and starts becoming a force, one that can build security, then freedom, then influence, then institutions that outlive the person who started them. And that is why this story begins with something so small it almost feels laughable. A few $1,000s, a modest paycheck, an automatic transfer, no one notices. Because that is how the machine always begins. Quietly. Ordinary. Invisible. No fireworks. No applause. No sign that anything extraordinary has started. But decades later, everything traces back to that one decision. Not the amount. Not the timing. The mechanism. It was always the mechanism. And the people who rise the highest are not necessarily the ones who start with the most. They are the ones who recognize the machine for what it is, early enough to let time do the rest.